The SPDR S&P 500 ETF, often referred to as SPY, is one of the most widely traded financial products in the world. It offers exposure to the S&P 500 index, which includes 500 of the largest publicly traded companies in the United States. Trading SPY can be highly rewarding, but it also comes with its own set of challenges. Many traders, especially those new to the market, fall into common traps that can lead to significant losses. To maximize your chances of success, it's essential to be aware of these pitfalls and adopt a disciplined approach. In this guide, we will cover 7 of the most common mistakes traders make when trading SPY and offer practical advice on how to avoid them. Mistake number 1: trading without a clear plan. One of the most critical mistakes traders make when trading SPY is entering trades without a well-defined strategy or plan. Many novice traders are eager to jump into the market without understanding the risks, objectives, or methodology behind their decisions. They may rely on gut feelings, news headlines, or short-term market movements to make trades, leading to inconsistent results and emotional decision-making. Why this is dangerous. Trading without a plan often leads to reactive and impulsive decisions, increasing the likelihood of buying high and selling low. Without a clear strategy, it's challenging to measure performance and learn from mistakes. How to avoid this mistake? Develop a trading plan. Define your goals, risk tolerance, and time horizon. Determine what types of setups you'll trade, like trend following, breakout, or mean reversion, and identify key indicators or patterns that will guide your entries and exits. Stick to your plan. Discipline is crucial. Once you have a plan, commit to following it consistently, even when market conditions are volatile. Backtest your strategy. Before applying your trading plan with real money, test it on historical data to ensure it works in various market conditions. This will give you confidence in your approach and help you avoid emotional trades. Mistake number 2: overtrading. Overtrading is another common pitfall, especially for traders who are new to the markets or who trade emotionally. This occurs when traders take an excessive number of trades without considering the quality of each trade, often due to impatience or the desire to make up for previous losses. Why this is dangerous. Overtrading leads to higher transaction costs, such as commissions and spreads, which can erode profits over time. Additionally, constantly entering and exiting positions increases the likelihood of making mistakes, as traders may not be able to analyze each trade carefully. How to avoid this mistake? Quality over quantity. Focus on high probability setups rather than trying to catch every move in the market. It's better to trade less frequently but with higher confidence in your trades. Set a daily or weekly trade limit. Limit the number of trades you allow yourself to take each day or week. This forces you to be more selective and only enter trades when the conditions are ideal. Take breaks. If you find yourself overtrading due to boredom, stress, or frustration, step away from the computer. Taking breaks helps maintain mental clarity and prevents you from making impulsive decisions. Mistake number 3: ignoring risk management. Risk management is perhaps the most critical component of successful trading. Many traders, however, neglect this aspect and focus only on potential profits, ignoring the possibility of losses. Without proper risk management, a single bad trade can wipe out weeks or even months of gains. Why this is dangerous. Even the most successful traders lose money on some of their trades. Without a proper risk management strategy in place, traders can experience substantial drawdowns that are difficult to recover from. Ignoring risk management can also lead to emotional trading, as traders may take increasingly larger risks to try to recover losses. How to avoid this mistake? Set stop-loss orders. Always use stop-loss orders to limit potential losses on each trade. A stop-loss should be set at a level that reflects your risk tolerance and the volatility of SPY. Position sizing. Calculate the appropriate position size for each trade based on your risk tolerance. For example, if you're willing to risk 1% of your trading account on a trade, adjust your position size so that the distance between your entry and stop loss represents no more than that 1% risk-reward ratio. Aim for trades with a favorable risk-reward ratio, at least 1 to 2 or higher. This means that for every dollar you're willing to risk, you're targeting at least $2 in potential profit. Mistake number 4, failing to adapt to market conditions. The stock market, including the S&P 500, is dynamic and constantly changing. What works in a trending bull market might not work in a choppy or bear market. Many traders make the mistake of sticking rigidly to one strategy, even when market conditions no longer support it. Why this is dangerous? Failing to adapt can lead to significant losses when market conditions change. For example, a trend-following strategy that works in a bull market may lead to multiple losses during a sideways or volatile market. How to avoid this mistake? Understand market conditions. Learn to recognize the different phases of the market: uptrend, downtrend, and consolidation. Adjust your trading strategy accordingly. Use different strategies for different markets. For example, in a strong uptrend, you might use a trend-following strategy like buying pullbacks. In a choppy market, you might switch to a mean reversion strategy that takes advantage of price oscillations within a range. Stay informed. Pay attention to key economic events, news, and macroeconomic trends that can affect the S&P 500. Understanding the broader context of the market will help you make more informed trading decisions. Mistake number 5. Trading based on emotions. Emotions such as fear and greed can heavily influence trading decisions, often to the detriment of the trader. For example, a trader might sell too soon out of fear of losing profits, or hold on to a losing trade too long out of hope that the price will rebound. Emotional trading often results in irrational decisions and poor risk management. Why this is dangerous? Emotional decisions rarely align with the logic required for successful trading. Trading based on emotions can lead to revenge trading, trying to recover losses by taking on more risk or exiting winning trades too early. How to avoid this mistake? Follow a trading plan. Having a predefined trading plan reduces the need to make decisions on the fly, helping to minimize emotional reactions. Set rules for exits and entries. Establish clear rules for when to enter and exit trades based on technical signals, not emotional impulses. Detach from the outcome. Focus on the process, not the outcome of each trade. Accept that losses are a natural part of trading and focus on long-term success rather than individual trades. Mistake number 6. Neglecting the importance of patience. Impatience is a major reason why traders lose money in the markets. Many traders expect immediate returns or feel the need to constantly be in a trade, leading to impulsive decisions. Trading SPY successfully requires waiting for the right opportunities, which often means doing nothing when the conditions aren't favorable. Why this is dangerous? Impatience can lead to chasing trades that don't fit your strategy or taking trades during low probability conditions. This can result in higher losses and frustration, which in turn may lead to more impulsive trading. How to avoid this mistake? Wait for high probability setups. Learn to sit on the sidelines when there are no clear trading opportunities. Patience is one of the key traits of successful traders. Avoid chasing the market. If you miss an entry, don't chase the market. Wait for the next opportunity rather than trying to force a trade. Focus on long-term success. Trading is a marathon, not a sprint. Understand that consistent profits over time are more important than making a quick buck. Mistake number 7, ignoring the impact of market news and events. The S&P 500 is highly sensitive to macroeconomic factors, corporate earnings reports, geopolitical events, and Federal Reserve announcements. Many traders make the mistake of ignoring these factors and focusing solely on technical analysis, which can result in unexpected price movements. Why this is dangerous? Major news events can lead to significant volatility in the market, causing price gaps and sudden reversals that can result in large losses for unprepared traders. Ignoring these events puts you at risk of trading in an environment you don't fully understand. How to avoid this mistake? Stay informed. Keep an eye on the economic calendar for key events such as Federal Reserve meetings, GDP reports, employment data, and earnings reports for major companies in the S&P 500. Understanding the broader market context will help you make more informed trading decisions. Use caution around major news events. Be cautious when trading around major news events. It's often better to wait for the market to settle after a significant news event before entering a trade. Combine fundamental and technical analysis. While technical analysis is important for timing entries and exits, having a grasp of the broader economic landscape and how news impacts the market will make you a more well-rounded trader. Conclusion. Trading SPY requires discipline and awareness. Trading SPY offers substantial opportunities, but it also comes with risks that can easily be magnified by common mistakes. To be successful, traders must develop and stick to. The secret of success is to get started, and the secret of getting started is to keep your mouth shut, your head down, and listen more. Mark Twain. The way to success is to be quiet and do what you need to do. Silence is golden. This saying is always true. Don't talk too much about what you are about to do. Learn to be quiet and work. Ignore everything around you. The criticism, contempt, ego, and self-esteem from yourself. Also, stop complaining and always saying negative things, because it directly affects your thinking and motivation. Even if things don't go as you want or everything goes wrong, keep quiet and keep working. It's like going to the gym. Your muscles have to endure pressure and fatigue before they can develop into the shape you want. Every success and wealth has its price, and that is the constant effort from yourself. Set these new goals and plans and write them down. Health, education, knowledge, family, finance, career, relationships, personal enjoyment. Goals and plans must be positive, realistic, that is, things we are capable of doing.